Hi, welcome back. This is Journey from the UIS Learning Hub, and this is video 3 on the fundamentals of financial accounting or accounting 211. Today we will be covering journal entries and then go over various examples to ensure you understand this vital piece of transaction analysis. Journal entries, similar to T accounts like we covered in the last video, are just another way to recognize and organize transactions under the double entry accounting system of debits and credits. So this is what a journal entry looks like. Typically, it's organized under a date column, a transaction column, a debit column, and a credit column, but sometimes there will be a post-reference column to cross-reference a transaction to the journal entry. But the majority of the time it'll be these 4 columns, and sometimes these columns won't always be written out, but they'll always be implied to be formatted this way. So starting with the date column, you write out the date of the transaction, which is pretty simple. Keep in mind that the date won't always be given. Your instructor may omit the date for the sake of time and convenience, because the main thing we're looking at here is that we know how to analyze the transaction. After the date section, you would want to identify the accounts involved in the transaction. In this example, we have identified utilities expense as the account being debited, putting the value it's being debited for in the debit column, and cash as the account being credited, putting the value it's being credited for in the credit column. Take note of how the debit account comes first, followed by the credit account, and then the credit account has an indent before the account name. All journal entries will follow this type of format. So let's take a look at an example now. So as we can see, this journal entry follows the same format as the one before it. So what is this entry telling us? Take a few seconds to try and figure it out. Well, we know the transaction is occurring on June 22nd, and the account that comes first and is being debited is cash. So from the company end, we are gaining cash, and we know fees earned, a revenue account, is being credited, which means that revenue is going up. So through reading this transaction as cash being debited and fees earned being credited, we know that a company is receiving cash on June 22nd through the revenue of their services. Now try writing your own journal entry. So in this example, John Incorporated paid $500 for equipment on account on June 1st. Take a few seconds to write out a journal entry and see if you can get it correct. Hopefully you took the time and figured it out. So first, what we want to start with is what we're given. So we're given the date, which is June 1st. Now in analyzing this transaction, we want to recognize what accounts are involved here. So we know we're gaining an asset in the form of equipment, and from the last video, we recognize that when an asset increases, it is debited. So equipment is debited first. Now to receive this equipment, we know we paid on account, which means we haven't paid cash yet, but we now owe money to the people we bought the supplies or equipment from, which sounds like a liability account called accounts payable. And as we know, when a liability increases, it has a credit balance. So the journal entry should look something like this. Now let's take a look at a third comprehensive example. This time it looks like this example incorporates more than 2 accounts. Take a few seconds and write out a journal entry and see if you can get it correct. Now let's look at the correct answer. Notice that this journal entry, although it incorporates a third account, it keeps the same format of the debited account being listed first, followed by the credited accounts under it with an indent. Also notice that the debit and credit sides also balance at $1,000 on each side. To summarize, journal entries are just another way to record transactions under the debit and credit lens. So first you plug in the date if it's given, and then you analyze the transaction and figure out which accounts are involved, and what will be debited and what will be credited. And then start by writing out the debited account and the value within the debit column, and then under that a small indent, and then you write the credited account and put the number value within the credit column. By the end of your journal entry, the debits and the credits should be balanced, meaning the amount on the debit side is equal to the amount on the credit side. If you're still having trouble figuring out which accounts are debited and which accounts are credited, if you refer to the last video on T accounts, that should try and help to reinforce the logic behind journal entries that you see in this video. That's all for journal entries. Next video we'll go over preparing adjusting entries, which are special types of journal entries prepared near the end of the period to ensure accounts are up to date. Thank you for watching.